Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics like wealth creation strategies, investment principles, creating passive income, paying off your debt faster, and much, much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I'm Billy and I'm joined by my co-host
Andrew. Bills, here we are back again in our recording studio.
Another day, another podcast, another wardrobe change.
Yeah, exactly.
So Andrew, what are we talking to everybody about today?
Yeah, so today we're back again with another market wrap. So really looking around financial markets, what's been happening, and what's been transpiring over the last month or so since the last time that we did another one of these.
Yep, and just to timestamp it as well too, we're recording it about a week out from when this is going live.
Yep.
So there may have been some things that happened between now and when you hear it.
Yeah, maybe.
But
maybe not.
Would say all of it's right.
Exactly.
So just a little bit
prepared.
of
we're always prepared.
little bit of a disclaimer.
Yeah.
Andrew, let's kick it off. What do we start with?
Yeah, look, one of the big things is the Fed raised rates in the last round of interest rate decisions. So they went up 25 basis points in the US, which was, more or less expected. There was some thought that perhaps they wouldn't, just given some of the concerns around the banking sector in the US. But yeah, we did see another interest rate rise over in the US of another 25 basis points.
The next meeting is in June.
Yeah. So I got another meeting in June.
Yep.
Look, whether they raise rates again, whether they don't, still pretty early to tell. There's still a lot more data to flow through. But at the moment, market is factoring in that they'll probably put a pause. They did even allude to it in their latest, the latest minutes is, the next one might be a bit of a pause in terms of rate hikes, but still plenty of time for that to change.
It's kind of like the new national sport, trying to guess what the Reserve Bank and the Federal Bank are doing in terms of interest rates. Right?
Exactly right.
So
exactly
there you go. But on that note, from the US perspective, so the inflation numbers that came through are slightly better than expected. The headline inflation number was 4.9%. So that could be a signal that the rates are going to be put on hold for next month anyway.
Yeah.
But once again, you're right, it's driven by data, so let's wait and see how that plays out.
Yeah, exactly right. And look, it's good to see inflation numbers starting to look somewhat normal. I know 4.9% is still marginally or substantially higher than where we'd normally expect it, but when we're seeing that number creep down towards that 2 to 3% that most reserve banks are aiming for, it's always a positive thing.
Well, I'd rather be talking about it in this position and sort of starting to creep down than still going the other way.
Yeah.
So hopefully it's an indication that the inflation, not only the inflation, but the interest rate increases are doing their job and starting to have an impact on inflation because the prices of things are starting to come back and slow down.
Yeah, exactly right. Still seeing a little bit of uncertainty over in the US, and market hasn't really decided whether it's a cause for big concern or whether it's no cause for concern or whether it's already been factored into the market or not is kind of the banking sector over in the US. That's definitely it's quite volatile at the moment, and so where that's going to land is still yet to be seen, but there's definitely some volatility in that sector as well.
Yeah, and I guess just on that note, and we've had some experience with this firsthand, so we were overseas and had the opportunity to be in the States not that long ago, and one of the things that I found fascinating is the amount of different banks. So you walk down a high street or a main street, and the amount of different banks there, it's completely different to what we're used to in Australia.
Yeah.
You have your top four, and then you have a few others that sort of sit off there, and then a few online banks like your Macquarie's and your INGs and things. But in America, there just seem every corner that you turn down, there seemed to be a different bank.
Yeah.
So it's not like when we talk about banking failures per se, it's not like the Commonwealth Bank, necessarily the Commonwealth Bank collapsing or CBA or ANZ collapsing or something like that. This is, a much smaller or less concentrated market in the United States. So their banking system and their banking structure is completely different to what we're used to in Australia.
Yeah, exactly right. So when you do say banking failures over in the US, I mean, some of the media is reporting it as though, they're over-sensationalizing it, sort of as you'd expect the media sometimes to do.
And because of the sheer number of banks, you'd kind of almost expect it. It's like saying that there's a number of businesses in a certain sector, you'd expect that.
Yeah.
If we saw a banking collapse in Australia, we'd be in serious trouble.
Yeah.
But once again, over in the States, it's a different environment. So you just need to interpret that with some caution, knowing what the market is like over there.
Yeah. Yeah. And speaking of the market over there, so sort of over the last week or so, S&P 500's been down approximately 0.25%. So we are seeing a slight downturn in terms of the US market over the last week or so, but nothing overly substantial or nothing that is outside the norm.
Yep. Jobs data.
Yeah.
That's a really interesting one in my mind, because strong economy, low unemployment would lead to inflationary activity.
Yep.
You need staff, so you're prepared to pay them more wages. It becomes a bit of a bidding war, which becomes inflationary and moves the price of things up. Yep. But what have we been seeing in the States, Andrew?
Yeah, so look, we did see unemployment falling slightly. So unemployment over in the States has fallen to 3.4%. So we're still seeing solid unemployment, despite the fact that we are still experiencing some major corporations over in the US, doing layoffs and making people redundant. But as a whole, unemployment is still falling and is down to 3.4%. It is slowing, so the rate of unemployment declining is slowing down, and so we might be starting to see the bottom of that. Again, who knows? But it's gone down again.
While we're talking about overseas, we can't talk about overseas without talking about China.
Yeah, exactly right.
So China's share market, we saw a rebound in March.
Yeah. So saw a rebound in March. And again, credit growth in April was weaker than expected.
Yep.
And a little bit substantially as well. So whether the growth in March was just purely as a result of coming out of that COVID zero policy and starting to transact as an economy, so whether that was just, overexcitement or not is still yet to be known, because we're still in the early days of that when we're looking at the Chinese market. But there was some weaker than expected data coming out of China as well.
Closer to home.
Yeah, closer to home. RBA.
The RBA, this is a really interesting one. I mean, look, at the start of the month, so we're talking about May, the Reserve Bank made the decision to increase interest rates again by 25 basis points. And to give some context, in April, they didn't move.
Yep.
So to pause and then to go again, this was definitely not expected. So it's going to be interesting to see what happens next month in June. But once again, using data, the Reserve Bank have come to the decision that another rate rise was needed, and they made the decision to go 25 basis points, which surprised, I think, most economists.
Yeah.
It was definitely not expected after seeing them pause in the previous month.
Yeah, and especially when you're kind of overlaying inflation data, that was quite positive that came out beforehand, and despite that, rates still went up by 25 basis points, so maybe a signal that they're expecting inflation data to, or it's not coming down to the rate that they expected it to. And so as a result, mortgage holders are, slapped with another increasing interest rate environment, which, there was some respite for a month, but certainly short-lived.
Well, it's going to be interesting when we start to talk about the property prices later on in this segment. But, increasing interest rates is an interesting one. I was of the opinion that last month they should have moved anyway, because I think that when you've got inflation, you need to make sure that it doesn't become stubborn and it doesn't become sticky. Yep. So if you've got some momentum, you need to keep going until you crush it. Don't know, maybe that's what the Reserve Bank is thinking at the moment now. We'll wait and see what happens next month, albeit in saying that mortgage holders, obviously they're going to start feeling the pinch even further. And from a deposit deposit holders' perspective, we are starting to see savings, online savings accounts, term deposits start to increase, and those increases are flowing through. So we are seeing better rates available for deposit holders as well.
Yeah, exactly. ASX was up 0.75 in the last week, which that wasn't straight off the back of the RBA announcement. It was sort of a week or so afterwards, but nonetheless we are seeing some gain in the ASX over the last week. We did some quick numbers and looked at the S&P 500 sort of over the course of a year. And so over the course of the last 12 months, ASX is up 8.3%, which is great considering the market and what's been happening over the last 12 months. It's been very tumultuous. We have seen, some concerns over in the banking sector in the US, not just over the last week or so, but really since, it's been a couple of months now. There's obviously been, inflation that's been stubborn across, investment markets worldwide. And despite that, ASX is still, doing its thing, and we're still up year on year.
And then, you go and sort of tie a bow around all of this in terms of the federal budget.
Yes.
So in May, the middle of the month, we saw the federal budget come out. Really didn't have much of an impact on markets.
It was pretty underwhelming, wasn't it?
What did we refer to it as? I mean, it was a fairly light budget.
Yeah.
I don't think there was really a huge amount in there that was unexpected. I guess as a government, when things are going well, because there is a surplus in the budget, surprising.
Yeah.
You don't want to make too many changes, I don't think, but there really wasn't much that happened in there. It didn't even move markets at all, actually.
Yeah. Didn't see much move to investment markets as a result of it, which generally is a sign that it didn't do very much. And look, it may have an impact, sort of a bit longer term.
Down the track, yeah.
And there were, some measures in it. Just gonna, shout out to the webinar that we did as well. But there were some changes in there that will impact some people, primarily when you're looking at, making the cost of living a little bit more affordable with some of the measures around Centrelink and age pension and all of that stuff. But yeah, in terms of impact to investment markets, it was very, very little.
Yeah, and I think some of the measures as well too, and this is, I think, one of the reasons why it didn't have too big of an impact on markets is because a lot of the things that they were talking about in the budget are actually proposals. So they're not coming in, they still need to pass through Parliament.
Yeah.
So a lot of things that they're talking about, like the stage 3 tax cuts, the fact that they're even referring to it in this year's budget when it's already in place coming out next year, you just leave it for the May budget next year. So, that's something that's not going to have an impact now. So I think that's the case. The cost of living pressure relief in there was a big one, but was expected, so that didn't really impact markets as well too. So yeah, nothing to see here, and keep moving on, which is what the investment markets have told us.
Yeah, exactly right. And similarly when we're talking about property, so there were some measures in the budget that were specifically designed to address some of the housing supply issues that not only we're experiencing now, so at the moment, obviously, when you're looking at particularly rental properties, the demand is massive, and in some areas of the state, it's bordering on extreme, but it's the housing supply is only going to become a bigger issue when you consider, the amount of immigrants that are expected to come into this country sort of over the next 12 months. And so one of the measures in the budget and also sort of what we're seeing at the moment is a few moving parts. And I think the housing market is kind of not sure which way to go, in that on one hand, you've got increasing immigration coming into the country. In addition to that, you've already got strong demand for property prices, or for properties. You've got an undersupply of properties, and at the same time, you've got interest rates, inflation, uncertainty, people coming off fixed rates. So all of these things that are kind of put together, we're not really seeing property prices, move consistently in one direction or another. And so where that's going to move to is really sort of yet to be seen. And there's a few moving parts in the property market at the moment.
Well, talking about the property prices per se, I was just having a look at the clearance rates, and they remain relatively healthy. And I guess that's the reason, because a couple of things. I mean, the houses and the properties are still selling. Stock is subdued, but some of the prices that are being, the results that are being coming through, some of them are still really healthy in the right market. So it's interesting with increasing interest rates. So servicing debt, servicing a mortgage is more expensive. We're still seeing, for those that have the appetite in the right areas, we're still seeing competition for certain houses.
Yeah.
So that's really interesting with a clearance rate that's still really healthy.
Yeah.
So go figure.
Exactly right. I mean, yeah, if you're waiting for property prices to decline, or either decline or rise rapidly, there's an argument on both sides, and so where that's going to land is really yet to be seen.
Yeah, time will tell.
Yeah,
it's definitely different than what I was expecting. I was sort of thinking, similar to COVID, you'd see a contraction in activity, and that's definitely happened because there's less stock. But seeing some prices where the reserve is not that our listeners can see it, but my hand's here, where the reserve's here and the price goes for that. That's interesting. Interesting behaviour.
Yeah, absolutely.
Where that lands, we'll wait and see.
Bills, thanks again for another market wrap. It's good to quickly jump on and do the rounds both in Australia and also internationally around what's been happening with markets and providing our listeners with a bit of our insights as to what's happened over the last month or so.
Like and subscribe, and we'll catch you on the next one.
Look forward to seeing you then.
Thanks.
Thanks for listening today. If you have any questions on what we've talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature and it is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amiridis and Andrew Nicolaou of 360 Financial Strategists Pty Ltd, authorized representatives and credit representatives of AMP Financial Planning.